This time it's different and things are never going to be the same. Okay, well, maybe not never, but not anytime soon, and certainly not in the next few years. But there has been a fundamental shift in the market, and unless you understand and accept it, you are going to struggle to make money in stocks. But first, we need to understand what has actually happened, and to do that, we need to go all the way back to 2007. You might remember this time when the whole financial system was shaken to its core and looked like collapsing. There was a run on the banks, and Northern Rock went under, Bear Stearns went under, Lehman Brothers went under, and it had a domino effect on the banking sector. So much so that the then Chancellor of the Exchequer, Alistair Darling, got a phone call from the Royal Bank of Scotland saying that they were going to run out of money in just a few hours. And you've got to remember that this was not only the biggest bank in the entire world, it was about the same size as the UK economy at that time, and if the government hadn't acted, then the cash machines would have closed, checks and credit cards would be useless, and people wouldn't have even been able to buy food. The entire financial system would have ceased to even work because it would have spread to every other bank as a knock-on effect, and you literally wouldn't have had any money apart from the physical cash that you already had. Nobody would have trusted banks anymore, that trust would have evaporated, and we would have seen runs on all of the banks in the UK, and this could have spread worldwide and completely brought the world's economy to a standstill.
If we had not done what we did, then the banking system would have collapsed.
So what happened is the UK government acquired a 58% shareholding in the Royal Bank of Scotland on the stock exchange and injected 45.5 billion into the company from October 2008 until the end of 2009. But this wasn't the only bank bailout. AIG was bailed out by the Federal Reserve for 180 billion, along with Bear Stearns, as well as Bank of America, JP Morgan Chase, Goldman Sachs, Morgan Stanley, and while this kept the banks afloat and the entire financial system alive, it did set a precedent, because people knew now that if things got so bad, the government would just bail them out. And because central banks had seen that fiscal stimulus had worked, it just didn't stop, and so it was the age where it rained money. So what did this mean? Like a bad dealer, the central banks got addicted to their own product and interest rates were kept low in order to encourage borrowing and spending, and money was cheap. Money was printed through quantitative easing programs where the bank just creates money and buys assets, and this sent asset prices soaring. So if you were a homeowner or heavy in the stock market, or you had investment properties, the 2010s really were the golden years. Everyone who had money made more, and for those who didn't, well, tough.
Sorry about that, pal.
And because things were so good, the party kept going, money kept being printed, and interest rates stayed low. What could go wrong? We'd avoided a recession for 12 years, stock markets were at record highs, and we thought it was different. We were wrong.
The people of the United Kingdom are now being advised to make drastic changes to their day-to-day existence.
In 2020, the COVID-19 virus travelled from Wuhan, made its way into Europe and swept across the world. Entire businesses went bust overnight. Primark learned the benefits of websites, and the Bank of England cut the interest rate back down to its lowest level in history at 0.25%, which was down from the already low 0.75%. The UK government launched bounce back loans and furlough. The US gave stimulus checks, and people were cooped up in their homes with nothing to do and still getting paid. So what did they do? Well, they saved it responsibly and everyone's bank accounts grew, savings went up, and they were able to get through the cost of living crisis because of that extra buffer. They bought stonks, of course. New investors who had extra money piled into the market at a time when borrowing was low and the stock market was attached to a rocket ship. Quality stocks went up, trash went up, crypto went up, and all you needed to do to make money was buy. It wasn't a question of if you made money, it was a question of how much. And I'm not going to lie, lockdown was one of the best parts of my trading career because of the insane volatility on the way down and then all the way back up and higher. Despite supply chains being ruined and the developing world still being obliterated by the pandemic, people thought still that there wouldn't be a recession and that the world would go back to normal, but then inflation started to creep. Materials became hard to get, there were delays in manufacturing, supplies became scarce, and you don't need to be Warren Buffett to know that when supply goes down, prices go up. And so it became a game of people putting the prices up to pass the costs on, and eventually the consumer had to eat the cost. And because inflation was going up, central banks started to intervene. The Bank of England raised rates 14 times in a row before a pause at 5.25% in November 2023, and this made borrowing expensive. And as those rates went up, companies thought twice about investment, because when the cost of capital was less than 1%, if your project was only 4% profitable, you still made a nice return. But suddenly, when rates were at 5%, it didn't make sense to borrow money at 5% if you could only achieve a 4% return, because that would have meant that you would lose money. And because everyone was upping the prices, people stopped spending, and because people stopped spending, companies started laying people off, and because companies started laying people off, even more people stopped spending, and we had this vicious negative downward spiral, and global stock markets were absolutely hammered. And like any great party, the aftermath is often just as big. Central banks have woken up from the stupor, and rates have risen dramatically. For the last 40 years, interest rates have steadily been declining, and most market participants, including myself, have never been active in any other market where interest rates weren't at rock bottom. So what does this mean for you? Well, the reality is this new world is here to stay. Inflation will peak and ease off, but the likelihood of us going back to 0.1% interest rates anytime soon is low. And that means we can't trust historic PEs or PE ratios, because the PEs of the 2010s were fueled by low rates, and so what was once on a PE of 30 can't just be normalised to the new post-pandemic high interest rate world. Average PEs are going to be lower, and higher multiples will be harder to earn. Borrowing is now going to be significantly more expensive, both for companies investing in projects or people like you and me buying houses. It also means that investing in debt is now more attractive, because for the first time in a long time you can get equity-like returns investing in credit without the huge downside risks of shares. It's also going to affect the investment market, because leverage was cheap but now it's expensive. So if you have to pay 7% carry, which is not unlikely, then you need to be making at least 7% just to break even. So what that means is there's going to be a reduction on capital inflows from private investors when the new bull market for small caps begins. We already know that net cash outflows have aggressively increased in 2023, hence why we're seeing so many takeovers, because stocks are cheap. Now, more takeovers means less quality stocks, and if we assume private equity and these bidders are taking out quality, that means that the average quality of the remaining listed stocks goes down. The LSE already has issues losing out on big listings, and whilst AIM is still attractive for new businesses, the statistics show that often these are to the benefit of management and not private investors, because most AIM shares destroy value, and it's the outliers that we hear about as success stories. Therefore, individual stock picking and being precise with trades has never been more important. But what it does mean is that at some point we see capitulation, where people are so sick and they can't take the pain anymore, and we'll be able to buy stocks at prices that you see once in a generation. So even though the market has changed and this time it is different, it doesn't mean that there isn't a huge opportunity out there for the people who stay standing. And by the way, YouTube says that you might like one of these videos, so hopefully I'll see you in a few seconds. Thanks for watching.